The Intelligent Investor. This video is based on key insights from the book The Intelligent Investor by Benjamin Graham. Introduction. Benjamin Graham began his book with a clear purpose: to teach regular people how to invest wisely. He wasn't writing a guide to get rich quick, because he believed there were no easy ways to make a lot of money in the stock market. Instead, he wanted to share important ideas and ways of thinking about investing, rather than just teaching how to pick specific stocks. He planned to look at how the market has behaved in the past, because he thought learning from history was key to making good decisions. He believed that forgetting the past could lead to repeating mistakes. Graham wanted to help people who thought of themselves as investors, not speculators. Speculators try to make money by guessing when to buy and sell, often following trends or charts. Graham thought this was a bad idea. He believed that buying when prices go up and selling when they go down doesn't make sense, and it's unlikely to lead to long-term success. He pointed out that most people who try to follow the market don't make money consistently. He considered this approach to be a common mistake. He used an example from 1929, when John J. Raskob predicted that saving just a little bit each month could make someone very wealthy. Raskob's prediction seemed great, but Graham showed that it didn't quite work out as planned. While the return wasn't as high as Raskob promised, it was still pretty good, proving that buying stocks regularly, even when the market is up or down, can be a smart strategy. This idea is called dollar-cost averaging. Graham emphasized that the book wasn't about predicting the future. Instead, it was about understanding how things have worked in the past and using that knowledge to make smart choices. He noted that the world of finance was changing, with new kinds of companies and financial tools appearing. He also pointed out some troubling events, like the bankruptcy of a major railroad and problems with some financial institutions. Despite these changes, Graham believed that the basic principles of investing shouldn't change. He explained that the interest rates on bonds had gone up a lot, meaning bonds were paying out more money than stocks. This made him wonder if it would be better to invest only in bonds until things changed. He also talked about the difference between two types of investors: the defensive investor and the enterprising investor. The defensive investor wanted to avoid losing money and didn't want to spend a lot of time making decisions. The enterprising investor was willing to put in the effort to find good investments and potentially earn a higher return. Graham believed that it was common to think that the best way to invest was to find companies in growing industries. However, he warned that this wasn't always easy. He used the example of airlines, which seemed like a great investment because air travel was growing. But despite the growth, airlines often struggled to make a profit. He pointed out that even experts could be wrong about the future of a company or industry. Graham's main goal was to help readers avoid making big mistakes and to develop an investment plan they felt comfortable with. He stressed the importance of understanding one's own emotions and psychology when making investment decisions. He believed that most people lose money because of their own actions, not because of the market itself. He also encouraged people to think carefully about how much they were paying for an investment, comparing it to what they were getting in return. He suggested that investors should focus on buying stocks of companies that were worth a reasonable amount, not just the most exciting or popular ones. He believed that buying stocks of solid, established companies at a fair price was a safer and more reliable way to invest. Graham concluded that while it was possible to achieve good results with a simple investment plan, improving on that standard required wisdom and effort. He cautioned against trying to be too clever, as it could often lead to worse results. He believed that learning from the past and sticking to sound principles was the best way to succeed in the long run. Chapter 1: Investment versus Speculation. Results to be expected by the intelligent investor. Benjamin Graham began by explaining the difference between investing and speculating. He believed that an investor carefully studies a company to make sure it's strong and likely to do well, and then buys its stock. Speculators, on the other hand, are like gamblers. They buy stocks hoping the price will go up, even if they don't understand the company or its business. Graham thought that most people on Wall Street confused these two things, calling anyone who bought a stock an investor, even if they were just guessing. Graham emphasized that investing is about safety and getting a reasonable return. It's not about trying to get rich quick. He used the example of bonds, which are like lending money to a company or the government. You're almost certain to get your money back, plus a little extra. Stocks can be trickier, but Graham believed that if you do your homework, you can find companies that are likely to be safe and profitable. He warned against chasing after the latest hot stocks or following the crowd, because those are often signs of speculation, not investing. He pointed out that things had changed since he first wrote about investing. Back then, many people thought stocks were too risky. Now, everyone seemed to think they could get rich by buying and selling stocks quickly. Graham worried that this was a dangerous trend because it could lead to big losses if the market went down. He suggested that investors should divide their money between safe bonds and well-established companies. He thought a good mix was about half and half, but it could change depending on how the market looked. Graham explained that even with good companies, there's always some risk. The price of a stock can go down, even if the company is doing well. He said investors should be prepared for this and not panic if the market drops. He also cautioned against using borrowed money to buy stocks, because that's a form of speculation. He believed that everyone who buys stocks on borrowed money should know they are taking a risk. He talked about how some people try to find special situations to make extra money, like buying stocks of companies that are merging or being taken over. While these can be profitable, Graham warned that they are also risky and require a lot of knowledge. He also mentioned the idea of dollar-cost averaging, which means investing a fixed amount of money at regular intervals, regardless of the stock price. This can help you avoid buying too many stocks when the price is high and too few when the price is low. Graham suggested that defensive investors, those who prioritize safety and avoiding trouble, should consider investing in well-established companies or even using investment funds managed by professionals. He also warned against trying to pick individual stocks that will do better than the average, because it's very difficult to do consistently. He believed that most investors are better off buying a mix of good, solid companies. For those who wanted to try and earn more than average, Graham said they needed to be careful and disciplined. He warned against trying to time the market or following the latest trends. He believed that the best way to find undervalued stocks was to look for companies that were selling for less than they were actually worth, based on a careful analysis of their businesses. He also cautioned against getting caught up in the excitement of the market and risking more money than you could afford to lose. Graham concluded by reminding investors that the stock market is not a game to be won. It's a place to build wealth over the long term by investing in good companies at reasonable prices. He stressed the importance of patience, discipline, and a healthy dose of skepticism. He believed that by following these principles, even ordinary people could achieve financial success. Chapter 2: The Investor and Inflation. Benjamin Graham began by acknowledging a common worry: inflation. He explained that when prices go up, the money you have buys less. This is a problem, especially for people who get a fixed amount of money each month, like a pension. Even people who own stocks might worry, because they hope their investments will grow faster than prices rise. However, Graham cautioned against jumping to conclusions. He pointed out that some people on Wall Street quickly decided that bonds were bad, and stocks were always the best choice because of inflation. He thought this was too simple. He believed that even good stocks aren't always a better deal than bonds, especially if the stock market is very high and doesn't pay out much in dividends compared to what bonds offer. He compared it to saying any bond is safer than any stock. That's just not true. To understand how inflation affects investing, Graham looked back at history. He examined price changes and how stocks performed over 55 years, starting in 1915. He found that the United States has seen inflation before, sometimes quite a lot. He noted that sometimes prices went down, and sometimes they went up, but generally, there were periods of rising prices. He suggested that investors should expect inflation to continue happening. Graham tried to figure out how much inflation to expect. He looked at the past 20 years and saw that prices generally rose about 2.5% each year. He thought it was reasonable to plan for about 3% inflation per year. He explained that this means about half of the money you earn from bonds would be used just to cover the rising cost of things. But he added, it didn't mean your money would lose value overall if you spent that half on living expenses. The big question then became, could stocks really do better than bonds, even with high returns on bonds? Graham pointed out that stocks had done well over the long term, but he wasn't sure they would continue to do so. He emphasized that investing isn't just about long-term trends. It's also about how you feel and what decisions you make year to year. Graham argued that there's no clear connection between inflation and how well companies do. He gave an example from 1966 to 1970, when prices rose a lot, but stock earnings and prices actually went down. He also looked at how much companies were earning compared to how much debt they had. He found that companies had taken on a lot more debt in recent years, which made it harder for them to make money. Graham explained that while it might seem like inflation helps businesses, it often doesn't. He said that companies need to grow their investments to make more money, and inflation doesn't always help with that. He also pointed out that wages were rising faster than productivity, and companies needed a lot of new money to operate, which kept profits down. He then considered alternatives to stocks for protecting against inflation. He mentioned gold, but pointed out that it hadn't really protected people's money in the past, and it doesn't pay any interest. He also talked about things like real estate, rare coins, and art, but warned that these could be risky and hard to manage. Ultimately, Graham concluded that investors shouldn't put all their money in one place, whether it's stocks or bonds. He believed a mix of both was best. He suggested that because of the uncertainties of the future, investors should be cautious and minimize their risks. He thought bonds were generally safer than stocks, but that a little bit of stocks was still important to protect against inflation. He reiterated advice from a previous edition, suggesting that at the time, stocks were overpriced and a significant portion of investments should be in bonds. Chapter 3, A Century of Stock Market History, The Level of Stock Prices in Early 1972. Benjamin Graham believed that investing in the stock market was like taking a small peek at a giant, powerful place. He thought it was important for investors to understand the history of the stock market, especially how prices have changed over time and how they relate to company profits and payments to shareholders. He pointed out that there was a lot of information available going back about 100 years, starting in 1871, which could help people make smart decisions. Graham wanted to show how stocks had generally grown over the years, even though there were ups and downs. He also wanted to look at how stock prices, company profits, and payments to shareholders were connected. He used information from the past to help people understand what might happen in the future. He looked at different periods of time, grouping them into 10-year averages to see how these things changed. Graham explained that the stock market has gone through many cycles, sometimes going up and sometimes going down. He described how the market behaved in different periods, like from 1900 to 1924, when prices generally went up a little each year. Then there was a time called the New Era, which ended with a big crash in 1929. After that, things were a bit unpredictable until 1949. He noted that the years after World War II saw a big increase in stock prices, but even then, there were some setbacks. He pointed out that some people got very excited about the big gains in the stock market and thought those gains would continue forever. But Graham warned that sometimes, when prices go up a lot, it might mean they've gone too far. He observed that the market then went down quite a bit, but quickly bounced back. He also mentioned that the stock market had grown a lot between 1949 and 1970, giving investors good returns. However, he noted that the growth slowed down in the last few years of that period. Graham also looked at how company profits and payments to shareholders had changed over time. He found that things generally got better after World War II, But the growth wasn't as strong in the 1960s as it had been in the 1950s. He believed that even though the past couldn't predict the future exactly, it still gave investors reason to be hopeful about investing in stocks. However, Graham also pointed out a worrying sign. In 1970, companies weren't making as much profit as they used to, and some were even losing money. He thought this might mean that the period of big growth was coming to an end. He also noticed that people were paying much higher prices for stocks compared to how much the companies were earning. This was a big change from earlier times, and Graham thought it was a warning sign. Graham believed that investors should be cautious and not get carried away by the excitement of the market. He compared the situation to the years before the big crash of 1929, and he thought that something similar could happen again. He suggested that investors should not borrow money to buy stocks and should not put all their money into stocks. Instead, he recommended keeping a mix of stocks and safer investments like bonds. Graham looked back at how he had advised investors in the past, in 1948, 1953, and 1959. He realized that sometimes he had been too cautious, and sometimes he had been too optimistic. But he believed that his main advice, to be careful and to invest for the long term, had been helpful. He suggested that investors should think for themselves and not just follow what everyone else was doing. Graham concluded by saying that the stock market was at a certain level in early 1972, and he thought it was a bit too high. He advised investors to be careful and to remember that the market could go down as well as up. He believed that it was important to learn from the past, but also to be prepared for surprises. He encouraged investors to stay calm and to stick to a plan, even when the market was going up or down. He thought that being patient and disciplined was the best way to succeed in the stock market. Chapter 4, General Portfolio Policy, the Defensive Investor. Benjamin Graham believed that how someone invests should depend more on who they are than on what they're investing in. He thought there were two main ways to be a smart investor, being active or being passive. An active investor spends a lot of time researching different stocks, bonds, or even groups of investments called mutual funds. They like to pick and choose, keeping a close eye on everything. It's like being a sports fan, always following the game and trying to make the best moves. But this takes a lot of time and energy. On the other hand, a passive investor wants things to be simple. They don't want to spend hours studying the market. They prefer a plan that runs itself without needing much attention. Graham called this the defensive approach. It might not be as exciting as actively picking investments, but it's easier and less stressful. He pointed out that being passive can be emotionally tough, because it means resisting the urge to react to every change in the market. Graham emphasized that both ways of investing can be successful, as long as you understand yourself and stick to your plan. He believed that controlling your emotions and keeping costs low were just as important as picking the right investments. When it comes to deciding how much money to put in stocks versus bonds, Graham didn't think age should be the main factor. Many people believe older people should have more bonds and fewer stocks, but Graham disagreed. He said it's more about your personal situation. For example, a young person saving for a house might not want to risk too much in the stock market, while an older person with plenty of savings might be comfortable taking more chances. Graham suggested a minimum of 25% of your money should always be in bonds or cash. He thought this would give people the courage to hold onto their stocks even when the market goes down. He explained that most people panic and sell their stocks when the market drops, which is usually the worst time to do it. Having a safety net of bonds can help you stay calm and avoid making mistakes. He recommended keeping your stock and bond mix fairly consistent, like a 70-30 split, 70% stocks, 30% bonds. If the stock market does really well, and your stock portion grows to 75%, you should sell a little bit of your stocks and buy more bonds to get back to your 70-30 target. This is called rebalancing. It's a simple way to make sure you're not taking on too much risk. Graham also talked about different types of bonds. He said that if you pay a lot of taxes, you should buy tax-free bonds called municipal bonds. These bonds don't have taxes taken out of the interest you earn. He also suggested buying bonds that mature in a few years, so you don't have to worry about interest rates changing too much. He believed that most people should buy bond funds instead of individual bonds, because it's easier to diversify and get a steady income. Diversifying means spreading your money across many different bonds, so you're not too affected if one bond doesn't do well. Graham warned against getting too excited about investments that promise high returns, like preferred stocks or annuities. He said that these investments often have hidden costs or risks that aren't worth it. He believed that sticking to simple, well-understood investments was the best way to protect your money. Finally, Graham suggested that even defensive investors could consider adding some stocks to their portfolio, especially if those stocks are paying a good dividend. He believed that carefully chosen stocks could increase your income and potential returns, even if you're primarily focused on safety. He emphasized that the key is to be disciplined, stick to your plan, and avoid making emotional decisions. Chapter 5: The Defensive Investor and Common Stocks. Benjamin Graham began by reflecting on how different things were when he first wrote about investing back in 1949. People were scared of owning common stocks, which are like pieces of a company, because they thought they were too risky. But over time, as stock prices went up, people started to think they were safe and easy money. Graham warned that high prices could actually hide risks. Graham explained that he believed owning stocks was a good idea for two main reasons. First, stocks helped protect your money from losing value because of inflation, which is when prices go up. Bonds, which are like loans to governments or companies, didn't do that. Second, stocks tended to give investors better returns over the long run. This happened because companies often shared their profits with stockholders through dividends, and the value of the stock itself often went up over time. However, Graham stressed that paying too much for a stock could ruin these benefits. He used the example of 1929, when stock prices were very high, and it took many years for the market to recover. He also pointed out that recently, stocks had become more expensive, making their dividend yields, the income you get from owning them, lower than bonds. Graham wasn't excited about buying stocks at that time, but he still believed that a smart investor needed to own some stocks, even if they seemed like the less appealing option compared to bonds. Graham suggested 4 simple rules for picking stocks. First, spread your money around. Don't put all your eggs in one basket. Aim for at least 10 different stocks, but not more than 30. Second, choose big, well-known companies that are financially stable. Third, make sure the companies have a history of paying dividends, which are like little bonuses for owning their stock. Finally, don't pay too much for a stock compared to how much the company has earned in the past. He suggested a limit of 25 times the average earnings over 7 years, but warned that this would exclude many popular growth stocks. Growth stocks are companies that are expected to grow their earnings quickly. While they can be exciting, Graham believed they were too risky for a defensive investor. He pointed to examples like International Business Machines and Texas Instruments, which had seen their prices and earnings soar, only to crash dramatically. Graham thought it was safer to focus on less popular, but financially sound, companies that were available at reasonable prices. Graham emphasized the importance of regularly checking your investments to make sure they are still good choices. He suggested getting advice from a trusted financial advisor at least once a year, but making sure the advisor follows his 4 rules. He also mentioned dollar-cost averaging, which is a strategy of investing a fixed amount of money regularly, regardless of the stock market's ups and downs. This can be a good way to avoid buying high and selling low. Graham believed that how much stock you own should depend on your personal situation. For example, a widow with a fixed income might want a balance between stocks and bonds, while a young person with a steady job might be able to invest more in stocks. The key is to be realistic about your knowledge, experience, and how comfortable you are with risk. Graham cautioned against confusing risk with price fluctuations. A bond is unsafe if it doesn't pay back the money it borrowed. A stock is unsafe if a company does poorly. But a stock's price going up and down doesn't necessarily mean it's risky, as long as the company is doing well. He believed that a well-chosen group of stocks could be safe, even if their prices sometimes fall. Finally, Graham offered some advice on choosing companies. He suggested looking for large, well-known companies that are financially stable. He provided some guidelines for what that means, like making sure common stock represents at least half of a company's total value or 30% for railroads and utilities. He reminded readers that these were just guidelines and that the most important thing was to use common sense. Graham concluded with a quote from Benjamin Franklin, reminding everyone that happiness comes from small, everyday advantages, not just big windfalls. Chapter 6, Portfolio Policy for the Enterprising Investor, Negative Approach. Benjamin Graham believed that even a smart investor should start with a solid foundation, just like a defensive player in a game. He suggested dividing your money between safe bonds and good, reasonably priced stocks. These stocks should be from companies that aren't too expensive, so you're not overpaying for them. He thought it was okay to try other investments later, but only if you had a good reason for doing so. Graham pointed out that it's tricky to give simple advice about being an aggressive investor because everyone is different. What works for one person might not work for another. He suggested that instead of telling people exactly what to do, he would give them some things to avoid. He thought that experienced investors should stay away from certain types of investments, like preferred stocks bought by big companies and bonds or stocks that are low quality unless they are really cheap, at least 30% less than their original price. He also advised against investing in bonds from other countries, even if they seem to offer a good return, and being cautious about brand new investments, even if they look exciting. For bonds, Graham recommended sticking to well-known, safe bonds that pay a decent amount of interest, around 7.1/4% for bonds you pay taxes on, or bonds that don't require taxes, which might pay up to 5.3%. He believed that if you're looking for a little extra money and a chance to make more, you could consider bonds that aren't as safe, but only if they are selling for a low price. He explained that sometimes, companies with money problems sell bonds at a discount because nobody wants to buy them. If you buy these bonds when they're cheap, and the company gets better, the price could go up, and you could make money. However, Graham warned that even these cheaper bonds are risky. He used examples of well-known companies like American Telephone and Telegraph and Atchison Topeka and Santa Fe Railroad, whose bonds were selling for less than their original value. He said that if you're careful, you can find bonds that offer both a good income and a chance to make more money. Graham also talked about what to do if things change and the prices and interest rates of safe bonds go back to normal. He reminded readers that the market often repeats itself, so it's important to be prepared for different situations. He cautioned against investing in bonds that are likely to cause worry. He explained that bonds that don't pay enough interest to cover their costs are risky because they might not be able to pay you back. He used the example of a railroad company whose bonds were selling for a high price, but were struggling to pay their bills. When the market got bad, the price of those bonds dropped quickly, and investors lost a lot of money. Graham emphasized that it's not smart to take risks just for a little extra income. If you're going to take a risk, it should be because you have a good chance of making a lot of money if things go well. He said that buying a bond that isn't very safe at its full price is usually a bad idea. He suggested waiting until it's cheaper, maybe selling for around 70 cents on the dollar. He also mentioned that some lower quality bonds and preferred stocks can bounce back if things improve. He pointed to an example of preferred stocks that didn't pay dividends for years during a long economic downturn, but eventually recovered and made a profit for investors who bought them when they were cheap. Graham warned against investing in bonds from other countries, explaining that they have often had a difficult history due to wars and economic problems. He said that if you buy bonds from other countries, you have no guarantee that you'll be able to get your money back. He also cautioned against rushing into new investments, even if they seem promising. He suggested carefully examining them and being skeptical, especially if they are being heavily promoted. Graham believed that the stock market often goes through cycles, with periods of excitement followed by periods of disappointment. He warned against getting caught up in the excitement and buying new stocks just because everyone else is doing it. He said that it's better to be patient and wait for stocks to become cheaper before buying them. He used the example of a company called VA Linux, whose stock price soared briefly before crashing, leaving many investors with big losses. Graham's overall message was to be cautious, do your research, and avoid getting caught up in the hype. He believed that the best way to make money in the stock market is to buy good companies at a fair price and hold them for the long term. He also stressed the importance of avoiding investments that are likely to cause worry and sleepless nights. Chapter 7: Portfolio Policy for the Enterprising Investor, the Positive Side. Benjamin Graham believed that smart investing wasn't about trying to guess what the market will do next. He thought it was about finding good, solid companies that are being sold for less than they're really worth. He suggested that most people should be what he called defensive investors, meaning they should play it safe and not try to be too clever. But for those who really wanted to learn and put in the effort, Graham offered some ideas for more active investing. He started by talking about special opportunities, like bonds that were backed by the government but offered extra benefits. These were a bit unusual, but Graham thought they could be good for investors who were willing to look closely. He also mentioned bonds from communities and industrial companies, which could also be a good deal if you did your homework. Graham warned that sometimes really low-priced bonds could be a bargain, but these were tricky and belonged to a special area where it was hard to tell the difference between bonds and stocks. When it came to stocks, Graham suggested 4 main ways to be an active investor. First, you could try to buy low and sell high, but he admitted that this was very difficult and required a special talent. Second, you could focus on growth stocks, which are companies that have done well in the past and are expected to keep growing. However, Graham cautioned that these stocks often sell for high prices, so you might be paying too much even if the company is great. He also pointed out that even the best companies eventually slow down, so it's risky to put all your money in just a few growth stocks. Graham suggested that a better approach was to look for bargain issues, stocks that are selling for less than they're really worth. He explained that this could happen when the market gets scared or doesn't understand a company's true value. He gave an example of buying stocks of companies that were unpopular or going through a tough time, but still had strong foundations. He also mentioned looking at companies that were selling for less than the value of their cash and other easy-to-sell assets. He showed how, over many years, buying these cheap stocks often led to better returns than just buying the average stock. Graham also talked about buying into special situations, like when a company is being bought out or is going through a legal problem. These situations can be complicated, but they can also offer opportunities to make money if you understand what's happening. He warned that this area required a lot of knowledge and wasn't for everyone. Graham believed that trying to time the market, buying when it's low, and selling when it's high was a losing game. He said the market was too unpredictable, and it was better to have a plan and stick to it. He suggested a simple approach called the 50-50 plan, where you keep a certain percentage of your money in stocks and a percentage in safer investments like bonds. When it came to growth stocks, Graham thought most investors would be better off not trying to pick the very best companies. He pointed out that professional investment companies, with all their experts and research, didn't consistently beat the average stock market return by investing in growth stocks. He believed that the prices of these popular stocks were often too high, and the risk of losing money was too great. Graham emphasized that even great companies can have big swings in their stock prices, especially if they become very popular. He warned against getting caught up in the excitement and paying too much for a stock, no matter how good the company seems. He used the example of General Electric and International Business Machines, which were both successful companies but could still have wild price changes. Graham suggested that a good strategy was to focus on large, well-known companies that were temporarily out of favor. He showed how, over many years, buying these unpopular stocks often led to good returns. He also mentioned looking for companies that were selling for less than their net current assets, which is like buying a company for less than the value of its cash and easily sold items. Finally, Graham stressed that being a successful investor required more than just luck. It required a policy that was both logical and different from what most people were doing. He believed that the three approaches he recommended, focusing on unpopular large companies, buying bargain issues, and taking advantage of special situations, met these criteria. He cautioned that these approaches required different kinds of knowledge and a willingness to do your homework. Graham's overall message was to be patient, disciplined, and to always remember that the market can be irrational, but investors don't have to be. Chapter 8: The Investor and Market Fluctuations. Benjamin Graham believed that investing shouldn't be about trying to guess what the stock market will do next. He thought most people get caught up in the excitement and fear of market changes, which can lead to bad decisions. Instead, he suggested focusing on the value of the companies themselves. He compared the stock market to a person named Mr. Market, who is always offering to buy or sell stocks. Sometimes Mr. Market is very happy and offers high prices, and sometimes he's sad and offers low prices. Graham said you shouldn't let Mr. Market's moods control your decisions. Instead, you should only trade with him when it's good for you, when he's offering a price that makes sense based on the company's worth. Graham emphasized that a smart investor should buy stocks when they are cheap and sell them when they become expensive. He used the example of a company called A&P. In 1938, A&P's stock price dropped very low, even though the company was doing well. Graham believed this was a great opportunity to buy the stock because it was being offered at a bargain price. Later, the stock price went up significantly, proving that Graham's decision was correct. He explained that the stock market often overreacts, creating these opportunities for smart investors. He also pointed out that many professional investors, like those who manage mutual funds, often make the same mistakes as everyone else. They are pressured to follow the market trends and buy stocks that are already popular, which can drive prices up to unsustainable levels. Graham believed that individual investors have an advantage because they are not bound by these pressures and can take a more thoughtful approach. He encouraged people to think for themselves and not blindly follow the crowd. Graham suggested a simple strategy: buy stocks regularly, regardless of the market's ups and downs. This is called dollar-cost averaging. By investing a fixed amount of money each month, you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost over time. He also recommended focusing on well-established, financially sound companies that trade at a reasonable price compared to their assets. He believed that these companies are less likely to experience wild price swings and offer a more stable investment. He also discussed the importance of understanding that stock prices fluctuate. Even good companies can see their stock prices go up and down. Graham advised investors not to panic when prices fall, but to view it as a potential opportunity to buy more shares at a lower price. He compared this to buying a house. You wouldn't sell your house just because the market goes down for a short time, would you? Similarly, you shouldn't sell your stocks based on short-term market fluctuations. Graham also touched on bonds, which are generally considered safer than stocks. He explained that bond prices can also change, depending on interest rates. He suggested that investors should choose bonds with a maturity date that suits their needs and be aware of the risks involved. He even proposed a new type of bond that would adjust its interest rate based on market conditions, offering both stability and flexibility. Finally, Graham stressed the importance of controlling your emotions and avoiding impulsive decisions. He believed that many investors make mistakes because they are driven by fear or greed. He encouraged investors to develop a plan and stick to it, regardless of what the market is doing. He likened investing to a game where the goal isn't to beat others, but to control yourself and make smart decisions over the long term. He believed that by following these principles, anyone could become a successful investor, even without trying to predict the future. Chapter 9: Investing in Investment Funds. Benjamin Graham began by explaining that a smart way for someone who doesn't want to take big risks is to put their money into shares of investment companies. These companies, often called mutual funds, let many people pool their money together to buy a variety of stocks and bonds. There are two main types, open-end and closed-end. Open-end funds let you buy and sell shares whenever you want, at a price based on what all the investments inside are worth. Closed-end funds have a set number of shares, so their price changes depending on what people are willing to pay for them in the market, just like regular stocks. Graham emphasized that all important funds are checked by the Securities and Exchange Commission, which makes sure they follow the rules. Back in 1970, there were a lot of these funds, over 380, with a total of $54.6 billion. Most were open-end funds, and they often had salespeople trying to get people to buy shares. Graham pointed out that there are different ways to sort these funds. Some focus on a mix of stocks and bonds, called balanced funds, while others mostly buy stocks. There are also funds that aim to make money from dividends and interest, or to grow your money over time. Another important difference is whether the fund charges a fee when you buy shares. A load fund does, while a no-load fund doesn't. No-load funds tend to be smaller because they don't pay salespeople. Graham explained that most funds are designed to avoid double taxation. This means they have to pay out most of their earnings, like dividends and interest, to their shareholders. These shareholders then pay taxes on those earnings, just like they would on their own investments. He also mentioned a newer type of fund that splits its investments into two parts. One that focuses on earning income and another that aims for growth. Many funds specialize in certain areas, like chemicals or overseas investments, and this is usually shown in their names. Choosing the right fund can feel overwhelming, Graham admitted, but it's not much different than picking individual stocks. He wanted to answer some big questions. Can you really pick funds that do better than average? If not, how can you avoid picking ones that do worse? And should you choose a balanced fund, a stock fund, an open-end fund, or a closed-end fund? Graham started by looking at how the whole fund industry had done. Surprisingly, he found that overall, funds hadn't done much better than people who picked their own stocks. However, he believed that, on average, people who invested in funds probably did better than those who tried to pick individual stocks. This is because funds protect people from making big mistakes and encourage them to save regularly. To understand this better, Graham looked at the results of 10 of the biggest stock funds. He compared their performance over several years to a standard measure of the stock market. He found that the fund's overall results were similar to the market, but they did slightly better in the later years. There was also a big difference in how well each individual fund performed. Graham didn't think it was bad that funds didn't beat the market. He argued that funds manage so much of all the stocks that their results are bound to be similar to the markets. He also pointed out that many professionals manage a lot of money, and their decisions influence the market. He then wondered if it was possible to pick funds that would do better than average. He suggested looking at which funds had performed well in the past, assuming that their managers were skilled. However, he cautioned that this might not always be true, especially if the market had been doing very well overall. Graham then discussed performance funds, which aim to achieve much higher returns. He warned that these funds often took big risks and that their managers were often young and inexperienced. He used the example of Manhattan Fund, which initially did very well but later suffered big losses due to risky investments. Graham believed that trying to beat the market consistently was a dangerous game. He then compared open-end and closed-end funds. Open-end funds let you sell your shares back to the fund at any time, while closed-end funds trade on the stock market like regular stocks. Closed-end funds often sell at a discount to their actual value, meaning you can buy them for less than what the investments inside are worth. Graham suggested that buying closed-end funds at a discount could be a smart move. Graham explained that most funds are designed to avoid double taxation by paying out most of their earnings. He also mentioned that some funds have two types of shares, one that receives income and another that receives profits from selling investments. Finally, Graham concluded that choosing a fund can be confusing, but there are ways to make smart choices. He would suggest looking for funds with a history of solid performance, reasonable fees, and managers who are invested in their own funds. He believed that, while it's hard to beat the market, it's possible to avoid the worst performers and achieve good results over time. Chapter 10: The Investor and His Advisors. Benjamin Graham observed that investing money is different from other businesses because people often get advice from others. Most investors aren't experts. They are like regular folks who think a professional can help them pick good investments. However, Graham pointed out a tricky thing about investment advice. People ask for advice to make money, but it's strange to expect someone to tell you exactly how to make a profit. Business owners ask for advice on how to run their businesses better, but they already know they need to make money to succeed. It's like asking someone to do the work for you when it comes to earning. Graham believed that investment advice is reasonable if it focuses on helping investors get what their money is expected to earn. A good advisor uses their knowledge and experience to help avoid mistakes and make sure investors get a fair return. Problems arise when investors want more than just average returns, or when advisors promise amazing results. It's important to remember that there's no guarantee of extraordinary profits. People get investment advice from many places: friends, family, bankers, newspapers, and special investment companies. Graham thought this showed that people haven't really figured out a clear way to choose advice. He suggested that if you rely on others to manage your money, you should stick to safe, basic investments, or you need to really know and trust the person giving the advice. If you want to try more exciting investments, you need to learn about them yourself and be able to judge the advice you receive. That's when you move from being a cautious investor to someone who's willing to take a bit more risk. Graham discussed different types of advisors. Some, like well-known investment counseling firms, are careful and promise only normal results. They mostly invest in reliable companies and government bonds, aiming to protect your money and provide a steady income. They don't try to time the market or make big, risky bets. They see their job as keeping you safe from big losses. Banks also offer similar trustworthy services. Other companies, called financial services, send out information and forecasts about the market. Some try to predict what the stock market will do. Graham wasn't very impressed with these predictions, saying they often use vague language to avoid being wrong. However, these services do provide useful information about the economy, which helps everyone make better decisions. Stockbrokers are another source of advice. They buy and sell stocks for people and often have teams of analysts who study companies. Graham warned that brokers sometimes focus on making commissions rather than giving the best advice. He believed that brokers should help investors avoid risky speculation and focus on long-term investments. He emphasized that the investor needs to be clear with the broker that they are not looking for quick profits, but rather sound, long-term investments. Graham also highlighted the importance of security analysts, who are experts in studying companies. He noted that these analysts are often influenced by the need to predict short-term market movements, which can cloud their judgment. He encouraged investors to ask the right questions and use their own judgment, rather than blindly following recommendations. He also mentioned the importance of investment bankers, who help companies raise money by selling stocks and bonds. Graham cautioned that these firms sometimes push investors to buy new issues, even if they aren't good investments. He advised investors to be careful and do their own research before buying anything recommended by an investment banker. Finally, Graham stressed the importance of being cautious and doing your homework. He suggested that even experienced investors should have their bank handle the delivery and payment of their securities for added safety. He warned against relying on promises of quick riches and emphasized the importance of understanding the risks involved in investing. Graham believed that the best investors are those who learn to think for themselves and make informed decisions, rather than blindly following the advice of others. Chapter 11, Security Analysis for the Lay Investor, General Approach. Benjamin Graham believed that figuring out how much a stock is really worth is like planning a trip. You need to know where you want to end up before you can decide which way to go. He thought investors should carefully consider several things before buying a stock, and he outlined 5 key areas to focus on. First, Graham emphasized looking at a company's long-term future. He suggested digging into their annual reports, which are like detailed diaries of how a company has been doing. Investors should ask themselves, what makes this company grow? Where does its money come from? He warned against companies that constantly buy other businesses, especially if they seem to be making bad choices. He also cautioned against companies that rely too heavily on just a few customers, as losing one could be devastating. Instead, he looked for companies with a strong moat, meaning they have something special that makes it hard for competitors to take their business. This could be a well-known brand, a unique product, or a way of doing things that's hard to copy. He also liked companies that grew steadily over time, rather than having sudden bursts of growth that might not last. Finally, he valued companies that reinvested their profits wisely, developing new products and services for the future. Next, Graham stressed the importance of good management. He believed that company leaders should be honest and straightforward, keeping their promises and taking responsibility for their actions. He didn't like managers who constantly talked about how great their company was, especially if they were trying to convince investors to buy the stock. He also warned against companies that frequently changed their stock options, a practice that often benefits the managers more than the shareholders. Graham wanted to see managers who acted in the best interests of the people who owned the company, not just themselves. Graham also believed in looking closely at a company's financial health. He suggested checking how much debt the company had and whether it was generating more cash than it was spending. He liked companies that were good at making money and using that money wisely. He also pointed out the importance of understanding a company's owner earnings, which is a way of figuring out how much cash a company has left over after paying for everything it needs to operate. Another important factor for Graham was a company's history of paying dividends. He believed that a long record of consistent dividend payments was a sign of a stable and well-managed company. He thought that if a company didn't need the money, it should return it to its shareholders. Finally, Graham considered the current dividend rate. He believed that a reasonable dividend was a good sign, but he didn't want to see companies that were constantly raising their dividends just to please investors. He thought it was more important for companies to focus on growing their businesses than on chasing short-term gains. Graham's approach was about finding companies that were undervalued by the market, meaning their stock price was lower than what he believed they were really worth. He believed that by carefully analyzing these factors, investors could increase their chances of making smart investments and achieving long-term financial success. He emphasized that investing should be a serious and thoughtful process, not a game of speculation. Chapter 12, Things to Consider About Per-Share Earnings. Benjamin Graham began this part of his teachings by pointing out a tricky situation investors often face. He said it's wise to not get too worked up about a company's earnings for just 1 year. But he also warned that it's hard to completely ignore those yearly numbers because everyone talks about them. Graham believed that investors needed to be careful because companies can sometimes make their earnings look better than they really are. He used the example of Aluminum Company of America, or ALCOA, to show how confusing things could get. ALCOA's report showed one set of earnings numbers, but then had a bunch of smaller numbers in the footnotes. Some were called primary earnings, others net income, and still others were fully diluted. It was like the company was trying to hide something. Graham explained that these different numbers could change how much an investor thought the company was really making. If you only looked at the first number, you might think ALCOA was doing great, but if you read the footnotes, you might see a different story. He illustrated how this could affect a decision. An investor might see the first number and think, wow, that's not bad. The stock is cheap. But if they had read the footnotes, they might have realized the company wasn't doing as well as it seemed. Graham emphasized that companies sometimes use tricks to make their earnings look better, like taking special charges. These are like unexpected costs that a company has to pay. Sometimes, companies will take these charges in one year to make the next year look better. It's like cleaning up your room right before your parents come over. Graham explained that companies might also have things called dilution. This happens when a company has bonds that can be turned into stock. If those bonds are turned into stock, it can lower the earnings per share. He also mentioned that companies sometimes use complicated accounting methods to reduce taxes or make their earnings appear higher. It's important to remember that companies are run by people, and sometimes those people have their own goals, which might not always be the best for investors. Graham suggested that investors should look at a company's average earnings over several years, like 7 or 10 years. This helps smooth out the ups and downs of the business and gives a better idea of how well the company is doing overall. He also said it's important to look at how much the company's earnings have grown over time. A company that's growing quickly is usually a better investment than one that's not. He used ALCOA again to show how this works. Even though ALCOA's earnings had grown a lot in the past, the stock market didn't seem to care much about it. Graham thought this was because people were worried about the company's future. He pointed out that sometimes, the market gets too excited about a company's potential and pays too much for its stock. Graham concluded by saying that investing can be tricky, and it's important to be careful. He advised investors to read the fine print, understand how companies are reporting their earnings, and not to get carried away by hype. He believed that the best way to be a successful investor is to be patient, do your homework, and stick to safe, proven principles. He wanted investors to remember that it's easier to get tricked with a pen than with a gun, meaning that financial tricks can be more dangerous than obvious threats. Chapter 13, a comparison of 4 listed companies. Benjamin Graham believed that investing should be like being a smart business owner, not a gambler. He wanted to show how to pick stocks that were safe and could grow over time. To do this, he looked at 4 different companies, ELTRA, Emerson, Emery, and M. Hart, to see how they were doing and how much people were paying for their shares. He noticed something interesting. Some companies, like Emerson and Emery, were selling for a lot more than others, like ELTRA and M. Hart. People were paying a high price for each dollar of profit these companies made. Graham wondered why. He figured it was because people thought these companies would grow a lot in the future. While that might be true, Graham believed it was risky to pay so much for a company based on guesses about the future. Graham looked closely at how well each company was doing. He checked how much profit they made compared to how much they owned, like a house or equipment. He also looked at how stable their profits were, seeing how much they went up or down each year. He found that all 4 companies were making good money, but Emerson and Emery were doing especially well. He also checked how fast they were growing and how much debt they had. All of them were in pretty good shape financially. He also considered how often they paid dividends, which are like little thank you gifts to shareholders. M. Hart had a really long history of paying dividends, which showed they were a reliable company. Graham thought it was important to pick companies that had a history of sharing their profits with investors. Graham pointed out that the companies that were selling for more Emerson and Emery had a history of exciting growth. But he warned that high prices can be dangerous. He compared Emerson to a company called Zenith, which had also been very popular, but then had problems. He said that if you pay too much for a company, even a good one, you're taking a big risk. He thought Emery Air Freight was particularly interesting because it was growing so fast. But he also cautioned that it was hard to keep growing quickly forever, especially when a company gets very big. He also worried that Emery might face new challenges, like more competition or changes in how airlines and shipping companies work together. Graham found that M. Hart and ELTRA weren't as flashy as Emerson and Emery. They didn't get as much attention from investors. But he thought they were solid companies with good records. He believed they were a safer choice for investors who wanted to be sure they weren't overpaying. He said these companies had a good value. You were getting a good deal for what you were paying. Graham's main point was that it's important to be careful when investing. Don't just chase after the companies that are popular or growing the fastest. Look for companies that are financially strong, have a good history, and aren't selling for too much. He believed that by following these principles, investors could build a portfolio of stocks that would perform well over the long term, even if some individual stocks didn't do as well as others. He emphasized that investing should be about owning a piece of a good business, not trying to guess which company will be the next big thing. He used an analogy of a pilot checking all directions to stay safe, reminding investors to always look for potential weaknesses and avoid overenthusiasm. Ultimately, Graham believed that an investor's approach should align with their individual preferences, whether they prefer exciting, high-growth investments or more stable, value-oriented ones. Chapter 14: Stock Selection for the Defensive Investor. Benjamin Graham believed that investing shouldn't be about guessing the future, but about finding good value in the present. He suggested that most people don't need to spend hours studying companies. Instead, they should focus on simple, safe principles. He thought a defensive investor, someone who wants to avoid big losses, could do very well by following a few basic rules. Graham recommended that defensive investors buy mostly high-quality bonds and a selection of well-known, leading companies. The key was to make sure they weren't paying too much for those companies' stocks. He offered 2 ways to pick those stocks. One was to simply buy a little bit of each company in a well-known group, like the 30 companies in the Dow Jones Industrial Average. Imagine buying 10 shares of each of those companies. It would cost a good amount of money, but it would give you a piece of many different businesses. Another option was to be more selective, using a set of rules to choose only the best companies. These rules were designed to weed out companies that might be risky. First, the company should be a good size. Graham suggested that industrial companies should have at least $100 million in sales each year, and public utility companies should have at least $50 million in assets. Smaller companies can be exciting, but they can also be more likely to have problems. Second, the company should be financially strong. Graham wanted to see that a company had enough money readily available to cover its short-term debts. He also wanted to make sure the company wasn't carrying too much long-term debt. Next, Graham looked at a company's history. He wanted to see that the company had made a profit every year for the past 10 years. He also wanted to see that the company had paid dividends, a share of its profits, to its shareholders for at least 20 years. A long history of profits and dividends showed that the company was stable and reliable. Graham also suggested looking at how much the company's earnings had grown over those 10 years, and making sure the price you paid for the stock wasn't too high compared to those earnings. Finally, he wanted to see that the price of the stock wasn't too high compared to the company's assets. Graham explained that these rules were strict, and they would eliminate many companies. But that was okay. The goal was to be safe, not to try to find the absolute best company. He believed that many investors were willing to pay too much for the best companies, hoping they would continue to grow quickly. Graham thought that was risky. He preferred to buy good companies at reasonable prices, rather than hoping for a miracle. He pointed out that even following these rules, a defensive investor could still make money. He suggested that the stock portfolio should have an earnings-price ratio, the opposite of the P/E ratio, at least as high as the current yield on high-grade bonds. This meant that the stock was earning a good amount of money compared to its price. When Graham looked at the companies in the Dow Jones Industrial Average at the end of 1970, he found that most of them met his criteria. However, only a few met all of them. He estimated that around 100 companies in the entire stock market met his standards, giving investors a good selection to choose from. He found that public utility companies were even easier to evaluate. These companies, which provide services like electricity and water, often had a good track record and were priced reasonably. Graham believed that these companies were a good choice for defensive investors because they were reliable and provided a steady income. Graham also talked about financial companies, like banks and insurance companies and railroad companies. He suggested that investors apply the same principles to these companies as they would to any other investment. He warned against getting too excited about railroad stocks, as they had faced many challenges over the years. Ultimately, Graham believed that most investors didn't need to be experts to make good investments. He encouraged investors to focus on simple, safe principles and to avoid trying to pick the absolute best stocks. He thought that diversification, owning a variety of stocks, was more important than trying to find a few winners. He also emphasized the importance of doing your own research and understanding the companies you invest in. By following these guidelines, even a defensive investor could achieve long-term financial success. Chapter 15: Stock Selection for the Enterprising Investor. Benjamin Graham began by explaining that choosing individual stocks can be tricky, even for experts. He pointed out that many investment companies, which hire the best financial minds, often didn't do better than simply owning a wide range of common stocks, like those in the Dow Jones Industrial Average. This showed that picking winners wasn't as easy as it seemed. He suggested that even smart people might struggle to consistently beat the average market performance. Graham wondered why this was so difficult. He thought one reason was that the stock market already considers a lot of information about companies, their past performance, current situation, and even what people expect for the future. Because of this, stock prices might already reflect everything known about a company. If that's true, any price changes would be due to unpredictable events, making it hard for even the smartest analysts to predict what will happen. He also noted that with so many experts studying companies, their opinions often become similar, which can keep stock prices close to what everyone thinks they're worth. He compared stock picking to playing bridge. Even the best bridge players don't always win, and sometimes luck plays a big role. Similarly, on Wall Street, even the smartest people can have their picks go wrong. Graham also mentioned that people sometimes get excited about certain industries or companies, paying high prices because they think they'll do well. However, he warned that very few companies grow quickly forever, and most experience ups and downs. Graham suggested that an investor who wants to pick their own stocks should be prepared for a challenge. While it might be hard to beat the best analysts, there could be opportunities to profit from stocks that others overlook or undervalue. To do this, the investor would need to use methods that aren't common on Wall Street. Graham and his company, Graham-Newman Corporation, had used specific strategies for 30 years, focusing on situations like buying stocks in companies that were reorganizing or liquidating, or purchasing convertible bonds. They also looked for companies selling for less than the value of their assets. One successful approach was to find companies whose stocks were trading for less than the value of what they own, things like cash and equipment. Graham called these net current asset or bargain issues. He often bought many different companies like this, hoping to spread out the risk. He also sometimes bought companies he thought he could control. Graham explained that his company tracked the results of each strategy carefully, stopping those that didn't work well. They focused on self-liquidating situations, related hedges, and bargain issues. He cautioned that these methods weren't for everyone, especially not for the defensive investor who preferred a simpler approach. For the more adventurous investor, Graham suggested looking for companies that weren't popular but were still doing well. He showed how to use a stock guide to find these companies, looking for those selling for less than their earnings or assets. He emphasized that while it was good to be optimistic, it was important not to pay too much for a stock just because you liked it. Instead, he suggested looking for cyclical companies, those whose performance goes up and down with the economy, when they were out of favor and selling at low prices. He also pointed out that sometimes, well-known companies can be undervalued. He gave an example of looking at companies that were making a good showing, but didn't attract much attention from the public. Graham encouraged investors to be patient and to look for companies with solid financial foundations, even if they weren't the most exciting choices. He believed that by following these principles, an enterprising investor could potentially earn better returns than the average. Chapter 16: Convertible Issues and Warrants. Benjamin Graham observed a growing trend in the financial world. Companies were increasingly using convertible bonds and warrants to raise money. These weren't your typical bonds or stocks. They were a mix of both, offering investors a chance to earn interest like a bond, but also the possibility of benefiting if the company's stock price went up. He noticed that these types of investments became especially popular towards the end of a good period for the stock market, which often signaled trouble ahead. Graham pointed out that while these investments were often presented as a win-win for both the company and the investor, that was rarely the case. It seemed too good to be true, and he believed it was. He explained that to offer both a bond's safety and a stock's potential for growth, something had to give. Investors usually ended up sacrificing either a good interest rate or the chance to make a lot of money. Companies, in turn, might give up some of the future profits that would have gone to regular shareholders. He used the example of convertible preferred stocks from 1946, a time when the stock market was doing well. These stocks didn't perform as well as expected, and he predicted that this would continue to happen, especially when the market started to go down. He found that these investments often didn't have the strong foundation needed to be truly safe, and they tended to follow the ups and downs of the overall stock market. Graham emphasized that convertible bonds weren't necessarily bad investments, but he cautioned against assuming they were automatically good. He believed that each investment should be carefully examined based on its own merits. He warned investors to be wary of companies that issued a lot of these convertibles, especially if it seemed like they were trying to hide problems or take advantage of a booming market. He also discussed stock option warrants, which he considered even more problematic. These were essentially long-term rights to buy shares of a company at a set price. Graham thought these were a risky and misleading practice, creating artificial value. He compared them to the French assignats, a type of paper money that became worthless during the French Revolution. He believed that warrants diluted the value of existing shares and didn't serve a real purpose. Graham suggested that investors should be cautious when dealing with these warrants, as they often led to losses. He explained that even if an investment seemed promising, it was important to know when to sell. Holding on too long, hoping for even greater gains, could lead to disappointment if the market turned sour. He shared a story about a group of investors who bought convertible bonds from a company called Eversharp. The stock price went up, and they converted their bonds into stock, but then the market crashed, and they lost a significant amount of money. Graham's advice was simple: don't get carried away by enthusiasm or market trends. Stick to sound principles and carefully analyze each investment. He believed that a good investment should have a strong foundation, a reasonable price, and a clear purpose. He also suggested that investors should consider switching from common stock to convertible preferred stock if the latter offered a better return and a safer position. Finally, Graham stressed the importance of being skeptical of complex financial instruments. He believed that many of these creations were designed to mislead investors and create artificial value. He encouraged investors to focus on the fundamentals of a company and to avoid chasing after the latest fads. He concluded that while there were always opportunities to make money in the stock market, it was essential to approach investing with caution, discipline, and a healthy dose of skepticism. Chapter 17: 4 Extremely Instructive Case Histories. Benjamin Graham began by explaining that the word extremely in the title was a clever trick, because the stories he was about to tell showed how things could go very wrong in the stock market. He believed these stories held important lessons for anyone who invested in stocks and bonds, not just regular people, but also experts and bankers. He wanted everyone to learn from the mistakes of others. He started with the story of Penn Central, a huge railroad company. It was so big, but it was being badly managed. People in charge of the company's bonds and shares weren't paying attention to warning signs. The company's stock price was very high, even though it was struggling. Graham pointed out that if people had just used simple rules for investing, they would have seen that Penn Central was in trouble long before it went bankrupt. For example, the company wasn't making enough money to pay its debts, and it wasn't paying any taxes. Also, its bonds could have been swapped for safer investments at a good price, but nobody did. Even though the company reported making a lot of money, Graham questioned how real that money was, especially since they weren't paying taxes. He concluded that anyone who knew a little about investing should have known not to own Penn Central's bonds or shares by 1968. Next, he told the story of Lingtemco, a company that grew very quickly by buying up other businesses. A young, ambitious leader was largely responsible for this rapid growth, but it ended badly. The company borrowed a lot of money to do this, and the banks kept lending them more, even when it was clear they were in trouble. Graham thought this was a mistake by the banks. The company's debts became enormous, and eventually it lost a lot of money. He wondered how the banks could have been convinced to lend so much money to a company that was clearly struggling. Then came the story of NVF Corp., which made a very unusual deal. A small company bought a much larger company, 7 times its size. This deal created a huge amount of debt and involved some tricky accounting methods. Graham explained that the deal made the company's financial situation look worse than it really was. He pointed out that the company's real value was much lower than what the stock market thought it was. He even described some unusual accounting tricks the company used to try and lower its taxes. Finally, he told the story of AAA Enterprises, a company that sold shares to the public based on the idea of franchising. The company wasn't really worth much, but people were excited about the idea of owning a part of a growing business. The stock price went up quickly, but it didn't last. The company went bankrupt just 2 years later. Graham was critical of the investment firms that helped sell the stock, saying they should have known better. He suggested that the government should do more to protect people from these kinds of risky investments. Graham ended by saying that while good management might have saved Penn Central, it was clear that no one who knew anything about investing should have owned its bonds or shares after 1968. He emphasized that investors should learn the basics of analyzing companies before trying to predict what the stock market will do. He believed that focusing on simple, safe principles was more important than fancy calculations or following trends. He wanted people to remember that investing should be about understanding what you're buying, not just chasing after quick profits. Chapter 18, a comparison of 8 pairs of companies. Benjamin Graham believed that investing shouldn't be about guessing the future, but about understanding what a company is worth right now. He thought many people got caught up in excitement and trends, buying stocks that were way too expensive. To show this, he compared pairs of companies, side by side, to highlight the difference between smart investing and risky speculation. He started with 2 real estate companies, one that was steady and careful, and another that was trying to grow super fast by doing all sorts of different things. The first company, like a wise grandparent, had been around for a long time, making slow but reliable investments. The other company, like a teenager trying to impress everyone, was buying up movie theaters, racetracks, and even a cosmetics company. It was taking on a lot of debt and using complicated financial tricks. Graham pointed out that even though the second company seemed exciting, it was also very risky. It was like building a house on sand. It might look good for a while, but it wouldn't last. He then compared 2 companies that made and sold gases. Both did similar things, but one was a newer, faster-growing company, and the other was more established. The market seemed to like the newer company more, even though it wasn't as profitable or strong as the older one. Graham explained that people often get caught up in the idea of quality, thinking that a company that's growing quickly must be a better investment. But he believed that a company's actual performance, how much it earns, and how well it manages its money is more important than just how fast it's growing. Next, Graham looked at 2 companies in the healthcare industry. Both were doing well, but one was making drugs and household products, while the other was supplying hospitals. The company making drugs and products seemed more exciting, But Graham noticed that it wasn't as profitable as the hospital supplier. He cautioned that sometimes, a company's price can be too high even if it seems promising. It's like buying a toy that costs way more than it's worth. He continued by comparing a tax service company and a clothing manufacturer. The tax service company was new and growing incredibly fast, while the clothing company was older and more stable. The market was going crazy for the tax service company, giving it a price that was unbelievably high compared to its earnings. Graham warned that such high prices are often a sign of speculation, not sound investing. The clothing company, on the other hand, was reasonably priced, making it a more sensible choice. Graham then paired a large, diverse company with a smaller one that made military equipment. The large company was doing many different things, but it wasn't very profitable. The smaller company, focused on making military supplies, was more profitable, even though it was much smaller. Graham emphasized that it's important to look at a company's profitability, not just its size. A smaller, profitable company can often be a better investment than a giant, struggling one. He then compared two companies that both made different products. One was a large conglomerate, and the other was a smaller company that made appliances. The conglomerate was trying to do everything, while the smaller company stuck to what it knew best. Graham showed how the conglomerate's complicated structure and rapid acquisitions led to losses, while the smaller company's focus and stability led to profits. Finally, Graham compared two companies that both made packaging, one that made metal containers and the other that made shoes. The metal container company was steady and reliable, while the shoe company was struggling. Graham pointed out that the market often overreacts to short-term news, and that it's important to focus on a company's long-term value, not just its current price. Throughout these comparisons, Graham stressed the importance of looking at a company's financial statements, understanding its business, and avoiding the hype and excitement of the market. He believed that by following these principles, investors could find undervalued companies and achieve long-term success. He also warned against chasing the latest trends and paying too much for a company, no matter how promising it may seem. Graham's core message was simple: invest wisely, be patient, and don't let emotions cloud your judgment. Chapter 19: Shareholders and Management's Dividend Policy. Benjamin Graham believed that being a shareholder wasn't just about buying a stock. It was about becoming a part owner of a company. He thought most people treated stocks like lottery tickets, hoping for a quick win instead of understanding the business behind them. Graham wanted investors to act like smart owners, paying attention to how the company was run and making sure the managers were working for them, not the other way around. He pointed out that, in theory, shareholders have a lot of power. They can choose who runs the company and how it's managed. But in reality, most shareholders just vote along with what the managers suggest, even if the company isn't doing well. Graham thought this was silly. He compared it to a situation where people wouldn't question a doctor's advice, even if the doctor kept making them feel worse. He urged investors to wake up and start paying attention. Graham suggested that investors should first ask two important questions. Is the company being run well? And are the managers looking out for the interests of the regular shareholders, the ones who own a small piece of the company? To figure out if a company is well run, Graham said to compare it to similar companies in the same industry. If a company is consistently performing worse than its competitors, that's a red flag. He also talked about dividends, which are payments companies make to their shareholders. For a long time, managers often wanted to keep all the company's profits, saying they needed it to grow the business. But Graham believed that shareholders were entitled to a share of the profits. He thought companies should pay out about 2/3 of their earnings as dividends, or show investors a really good reason why they were keeping the money. He noticed that companies that paid out good dividends often had better stock prices. Graham used examples to illustrate his points. He talked about Texas Instruments, which didn't pay any dividends but saw its stock price soar as the company grew. He also mentioned Superior Oil, which eventually stopped paying dividends altogether, but its stock price kept climbing. These examples showed that investors were starting to value growth over dividends. However, Graham warned against companies that kept profits to themselves because they were struggling. He believed that if a company was doing poorly, keeping profits wouldn't magically fix things. Instead, it often led to a lower stock price. He thought shareholders had a right to ask why the company wasn't sharing the profits. He also discussed stock dividends and stock splits. A stock dividend is when a company gives you more shares of stock, but it doesn't really change the value of your investment. A stock split is like cutting a pizza into more slices. You still have the same amount of pizza, just in smaller pieces. Graham preferred companies to pay cash dividends, which are real money you can spend. Finally, Graham emphasized the importance of reading the company's proxy statement. This document tells shareholders about important decisions the company is making, like who's on the board of directors and how much the managers are getting paid. Graham believed that investors should carefully review this document and vote their shares to hold managers accountable. He thought it was a way for even small investors to make their voices heard. Graham's overall message was clear. Being a shareholder means being an owner, and owners have a responsibility to pay attention and make sure their company is being run well. Chapter 20: Margin of Safety as the Central Concept of Investment. Benjamin Graham believed that the most important thing an investor could do was to avoid losing money. He thought that trying to get rich quickly was a dangerous game, and that it was much smarter to focus on protecting what you already had. He compared it to a saying from an old legend: "This too will pass." It means that good times and bad times don't last forever, so it's important to be careful no matter what's happening. Graham suggested a simple motto for investors: margin of safety. This means buying things for less than they are really worth, so you have a cushion if things go wrong. Graham used the example of railroads to explain this idea. He said that a good railroad company should earn enough money to pay its debts easily, more than 5 times over. This extra money is the margin of safety. If the railroad doesn't earn enough, it could have trouble paying its debts, and the people who lent the railroad money could lose some of it. Graham pointed out that investors don't expect companies to always do as well as they have in the past. Instead, they want to make sure the company has enough extra money to handle unexpected problems. He also explained that you can calculate the margin of safety by looking at how much a company owes compared to how much it's worth. If a company owes $10 million but is worth $30 million, there's a good safety margin. Even if the company's value goes down a lot, the lenders are still protected. Graham said that this idea of a safety margin applies to common stocks too. Sometimes, a company's stock might be so cheap that it's safer than a bond. This happens when the company is worth more than the amount of bonds it could safely issue. Graham gave the example of National Presto Industries. In 1972, the company was worth a lot, and it could have easily paid off its debts with bonds. Because the stock was selling for less than its true value, it was a good investment. He explained that even if a company doesn't have a huge safety margin, having a little extra earning power can still protect you. If a stock earns 9% and bonds earn 4%, the stock has a 5% advantage. This extra money can be used to grow the company and make the stock even more valuable. Graham warned against buying stocks that are too expensive. He said that it's better to buy stocks at an average price over many years, rather than when the market is high. He also cautioned against buying stocks of companies you don't understand. He believed that most investors lose money because they buy low-quality stocks when things are going well. They think that good times will last forever, but they don't. Graham also talked about growth stocks, which are companies that are expected to grow quickly. He said that these stocks can be a good investment if you carefully estimate how much they will grow and don't pay too much for them. He emphasized that the price you pay is always important. A stock might be a great company, but if you pay too much for it, you're still taking a risk. Graham believed that the best investments are those that are undervalued, meaning they are selling for less than they are really worth. This gives you a safety margin to protect you if things go wrong. He said that even a company that isn't doing great can be a good investment if you buy it at a low enough price. He used the example of real estate bonds that were once considered risky, but became good investments when their prices dropped significantly. Graham stressed the importance of diversification, which means spreading your money across many different investments. This way, if one investment does poorly, it won't ruin you. He used the analogy of a roulette wheel to explain this. If you bet on one number, you have a small chance of winning, but a big chance of losing. If you bet on many numbers, your chances of winning increase. Graham believed that there was a difference between investing and speculating. Speculating is taking big risks in the hope of making a lot of money quickly. Investing is more cautious and focuses on protecting your money. He said that the key to investing is to have a margin of safety. This means buying things for less than they are worth, so you have a cushion if things go wrong. Graham concluded that the most important thing for an investor is to be sensible and businesslike. He said that people who are successful in business should apply the same principles to investing. He advised investors to know what they are doing, to be careful about who they trust, and to only invest in things that have a good chance of making a profit. He believed that by following these principles, even a regular person could be a successful investor. And that brings us to the end of our summary of this book. I hope you found it insightful and valuable. If you enjoyed this video, hit like and subscribe for more. Your support helps us bring you more great content. Thanks for watching.